All right, welcome back everyone to Capital Mindset. I'm here with my co-host Andrew. Today we're going to be pitching you guys Dave. We're going to be going over the stock, what it's done in the past, and what we think it's going to do in the future. So, Andrew, what is Dave? This is a very, strange sounding company. It's the name of your neighbor, your coworker.
That's supposed to dox where I live.
Yeah.
No, I'm surrounded by Daves. So Dave is a company that provides earned wage access. And there's some neobank services. You can think of it as a substitute for a payday lender. It's a little bit more complex than that, but for simplicity, we'll just say a payday lender for now. Maybe get into it later. Effectively, what they're doing is just helping people, lower income people with liquidity issues. So I need to make it to Friday. It's Tuesday, and I have rent due. I take out one of these little Dave loans, and I pay them back. And what Dave does is they take a 5% fee for providing you that liquidity. It's actually interesting, and I should have had this ready. But there's a company called Opturn, and I was listening to a pitch on them, and someone was explaining how Opturn is so much better for you than traditional payday lenders because of the lower cost. And I was like, well, it's a good thing they don't have Dave on this slide, because it would make them look so bad. Because, let me see if I can find it here real quick. But effectively, an average payday lender is going to runs at a 400% APR. Let's say 2 to 400% APR. And so I'm going to share really quick my screen just to kind of think about this for a second. So right here is the slide. This is from Opturn. Don't worry about their payday lender. It doesn't matter what they do. But what it's showing here is here's the cost of borrowing $1,500 for the average person. So an online-only payday lender, it costs you $3,500 to borrow $1,500. That's insane. Online installment, and so they show here, well, Opturn, it looks so much, the weighted average is $2,500. Think about that. Imagine paying $2,500 to get $1,500. That's actually insane. Opturn is trying to make themselves look, and they do look a lot better than these other options, if this is all true. $500. Dave on this chart would be at $75. So Dave would, be like right here. It's a fraction of Opturn. It's less than 20% of what Opturn is. And so now, there's obviously some caveats, is that Dave can't just give you $1,500 up front. It would be in like $500 or $300 installments. But either way, it just shows the difference. And the reason is, and the other thing with Dave is it's not a loan with an APR. It's a one-time 5% fee, right? So that's what they do. That's the primary meat and potatoes of the business. They also have a card. They have a debit card. They have some banking services. But the primary thing that they do is these earned wage access programs. This is a company that we've actually been following for quite some time. I think it originally got pitched to us back in the 30s. My weighted cost is now like 90. It's like high double digits. So we've been in this for a while, and we've known about it. Just there was some issue with their previous model, because now, like I said, it's a straight 5% fee. They have a current, and this is, I think, one of the things maybe keeping the price down or keeping the multiple low, is they have an open lawsuit against them that's currently with the DOJ. It was brought forward by the FTC and given to the DOJ. It shouldn't be an issue anymore, because what they are doing is suing them over their old business model that no longer exists within Dave, which was, not to get too into it, but there's like this tipping method, and people thought it was a little bit, what's the word? Deceptive. And so now Dave's completely off that model, and they're on this new model. So while they're going through that transition, because this is a relatively recent, the DOJ got this on December 30th, 2024. And while they're going through that transition of going into this new model, people were uncertain what it's going to look like, because this deceptive part of their old model was 20% of the revenue. And it turns out that the new model is actually more profitable, drives more revenue for the company per loan than the old model. And so now what you have is you have a company here that we'll start getting to where I get really pulled up is they do this program. It has insanely high margins. So if we want to go down a little bit, we can look here. Off 108 million of revenue, they're doing 44 million of adjusted EBITDA. We'll just round it and say 40% EBITDA margins, super high. The question you probably have with something like this is how do you have high margins if you're only charging 5% and you're having the lowest income investor base being the ones borrowing from you? Because in theory, that's going to be the highest likelihood of defaulting. And the answer is a couple of things. Is one, their underwriting. So instead of just like a traditional credit lender, just trying to look at different things like maybe your credit score or items like that, they use a Plaid API to log into your bank account so they can see all your transactions, analyze it, and help underwrite their micro loan to you based off of that. And these are super small duration. So if I take a $300 loan from Fabio and I don't pay him back, Fabio loses $300. It sucks.
I mean, it's sad, yeah.
And maybe a little sad. But if I take a mortgage from Fabio for $500,000 and then I default, Fabio's a little more sad. Maybe he's big mad.
I'm big bad coming for you.
He said soon. So, it's and the thing that's really cool about the Plaid API is it authenticates and allows Dave, because it has to be authenticated, but the default is to be authenticated. It allows them to do an auto sweep of the money that you owe them on the day that it's due. So if I borrow money from Fabio for $300 from Dave, and I say, I don't want to pay Fabio back. And so Friday comes and I say, well, I'm not going to pay Fabio. I'm not going to go ahead and send him money. Fabio goes, that's fine. I'm going to use my Plaid API, go in and sweep the money to me because you owe it to me. It's money due to me. I'm taking what's rightfully owed. So Dave has that access. And I want to say in Q1, their default rate was like 1.5%, which it's another thing that people miss a lot because I think a lot of people look at the balance sheet and the amount of outstanding loans versus the allowance, and it looks like it's like 20%. It looks really high. But that's because these loans, they turn over so fast because the average length is like a week, So you can't really look at the balance sheet and have that be an indicator. But they tell you, so right here, 1.5 billion in originations, 1.5% 28-day delinquency rate. So really low delinquency rate for what you would expect. Now, I'm going to get into the real exciting part. So we kind of know what the business model is. It's very profitable. I guess I should cover one other thing is the reason the company traded down so much was there were serious concerns about them going insolvent. This kind of model, there's a lot of high fixed costs, but once you get to scale, it really just becomes profitable. The variable costs are low, the fixed costs are high. So they're at that level now where they've gotten out of the fixed cost hurdle, and they're kind of at like acceleration breakout. Like they've broken out their profitability is just growing extremely fast. So when I saw the Q1 report, the thing that stuck out to me is they did adjusted EBITDA of 44 million. And look, you can see the year-over-year growth in top line and bottom line. EBITDA's up 250%. Top line's up, I don't know, that is like 30%, 40%, something like that. Oh no, right there, 47%. I can't read. 47%. So growing extremely fast. Here's their adjusted EBITDA. This is a run rate 176 million adjusted EBITDA. And the reason I'm referencing this is the number they guide off, and any sell-side analyst estimates are derivative of that. So if you go to their guidance, they guide to midpoint of 160 million EBITDA, which is below current run rate on a company that's currently growing it at, it's not going to be the same growth year over year, but 250% year over year. And here's a very important thing. I'm going to pull up the transcript because this is something that's really exciting. I don't think I'm going to just hit that and it'll sign me in. on the Q1 call, because they're talking about this new model. Because remember, we talked about they only moved to the new model for the first time in Q1 of this year. The CEO talks about how the new model is working for him and how much better it is. He says March was the first quarter that they're on the new model. And it's 11:40, yeah. And so what he shows here is that here's the 7th consecutive quarter of double-digit ARPU expansion. Much of this improvement in Q1 is attributable to higher average revenue per origination, which came in at approximately $11.40, up 26% year over year and 12%. In March, which is the first full month operating under our new fee model, average revenue per origination was over $13. So you not only are a company that has been growing fast, your new model now is making 15% more revenue per customer. So now your ARPU is up 15% quarter over quarter in theory here. And I should add one last thing, is the customer acquisition cost in this company is like insanely low. I want to say it was $18 in Q1. So you have CAC payback in like 2 weeks based off loan cycles. So it's like insane. So that's the model. So we have a company growing at this insanely fast rate, and their EBITDA guidance is 10% below current run rate EBITDA. So my assumption, and I should give a shout out to one of the members in our community, Garzi. He's the guru on this. Like, he knows this stuff super well. I have 210 million EBITDA. I think he's higher. I want to say he's 220, 230 million of EBITDA is what he has for fiscal year 25, which calendar year 25. So we have somewhere around 40 to 50% higher than the current sell side estimate and guide by management. And this is before you even think about the fact that, like, we haven't even talked about valuation expansion, because just off that alone, you're talking a 40 to 50% bump in the price of the company. And at some point, you imagine valuation expands. You have a really profitable company that keeps growing faster than people think. The one thing probably holding back maybe is a lawsuit, and then people just seeing the stock price because it's gone on this parabolic run, and people being like, "Oh, this is just like some bubble stock," and not understanding that most of this is fundamentally based. Because if my numbers are right, I have 172 million of adjusted net income for the year. And if you take a fully diluted market cap, I want to say now it's probably at like almost 3 billion. You're talking like a 17 times multiple on that, which is not, I mean, that's cheap. It's lower than the market. So really, it's maybe, it's not maybe, it is the number one position in my account. It's the position I'm most bullish on. I feel very good about where the direction of this company is going. The only concerns I really have, things that could trip this up, is if unemployment shoots up, which I was showing data today showing it seems like that's not the case. It seems like the economy is doing fine, unemployment data is positive, or the company decides to try to really expand into other product offerings, which would water down their profitability. That's really the only things that we see as hurdles here. And then there's obviously, like, you don't know what's going to happen with the DOJ lawsuit. Based on the fact that they're no longer running that model, my assumption is they're just going to get a slap on the wrist fine and move forward. And when that happens, you could also get valuation expansion potentially because they don't have a lawsuit anymore. But that's like the super quick pitch on Dave. Did I miss anything?
I don't think so. I think you covered the valuation. What multiple they're trading at to emphasize that?
So I have it right here. Current EBITDA guide. You can go off EBITDA or net income. It says 17 times EBITDA, and off sell side estimates 25 times PE.
And it's growing how fast?
I mean, like 100% year over year is what they're going to grow this year. Something
So,
insane. I mean,
so that would make it a peg under one for some simple, ratio.
yeah, it would be a pick. Yeah.
It'd be a peg under one. Yeah. Okay. So yeah, I like the story here, right? Well, I'm to the audience. This is not a new story to me. Andrew, Garzi, all of them been really bullish on this company for quite some time. So I'm looking at a fintech that everyone. You go on Twitter, you go on YouTube, and everyone's interested in these other fintech banks that are really shiny, and they're missing out on this one over here. I love their logo, by the way. Just like a side note, the friendly bear. Yeah, exactly. So
Also,
you're
kind of
looking
creepy
at
bear. That's another.
well, depending, yeah. If you get the edit one from Bobo, um,
Oh, just like, did you ever watch Home Improvement?
Home
This,
Improvement, probably
there's like
did.
there's a scene there's a guy and he like you only ever see like the top of his face. It's kind of like the bear hair. So he's like, "Howdy, neighbor." It's the neighborly guy. But anyways, that's what it reminds me of.
Well, okay, so we have like a bank growing, or not a bank, sorry, a payday lender. I know
It's
that's a word, but effectively, it's a nicer payday lender.
it's an earned
Uh,
wage access,
okay,
EWA.
earn wage access business
Okay.
that is a much better, friendlier model to the consumer than existing models out there. Correct?
Mm-hmm. Oh, for sure.
So you don't really feel bad investing in this. In fact, because if none of these companies existed, those customers just wouldn't have any access to money.
All of this right here is market share that they can eat up. All of it.
That's beautiful right there.
Yeah, I mean, and like I said, they have lower dollar value, lower dollar amount loans. But on the last call, management's saying we're looking to do slightly longer duration, larger dollar amount loans. What do you think they're targeting? They're it's you guys want like disruptive stuff? Like this is disruption. It might not be sexy disruption.
It's
That's
pretty
that's it.
sexy. The margins, the growth rate, that's pretty
Yeah.
sexy.
But I'm saying it's not like space, tech. I mean, it's
Well,
fintech. But it's not like, but like for a lot of people, like this is boring. So people don't
I,
look at it.
I think unfortunately, like what it becomes sexy is, whose idea was it? Was it yours or was it put into you? Kind of question, right? Because if something is talked about by a lot of finfluencers, that I go, "Ugh," like, oh,
Yeah.
I don't want to be put in that category at all. And suddenly you have like this circle jerking going around where what's the best stock to buy right now? Everyone has like the same 5 stocks on their list, and that's what happened on social media. And so that's what I guess just quote unquote
Mm-hmm.
defines sexy. Dave here, even though it's had stellar performance, at least since like 2022, because you already described what happened. Sorry, not 2022. 2022, it had terrible performance, but that's because of the valuation it IPO'd at, correct? During the SPAC.
Well, it was a much riskier company back then. Okay, so it was a company.
Teetering on bankruptcy, I think you said.
Okay, so maybe doing 200 million in top line. Let me make sure these financials are correct. Let's go back here. So we want to look at 2022 or 2021. Yeah, so 204 million in top line revenue in 2022. Negative 130 million in operating income. So they were like, just burning money. And this is why this industry is tough. You have to get the fixed expenses and the underwriting to a point where you become profitable. Once you become a profitable, the word I was looking for, escape velocity. Once you hit that escape velocity, it's just this profitability machine. And so, and they had some kind of luck break for them. They had some of their debt was from FTX. When FTX went bankrupt, they got to buy it back cheap. That was one thing that helped them out, like because there was serious concern. There was legitimate concern of them going bankrupt at one point. If you go back to like 2022, you have 191 million. Yeah, that's right for the SPAC. 191 million cash. How much do they have in debt? 177 million in debt. So they were at a net even on like net cash, and you were burning like 200 million in operating expense. You had 1 year, 2 years to live. So they had to like cut down on expenses and do a lot of things to kind of live, thin the business out. There's a lot of businesses in the space that just go bankrupt, which is also good for Dave. But
Less competition.
well, it's also just more market to take.
Yeah.
So
what do you think this company is gonna look like 5 years from now? Close your eyes.
Oh, I don't have a 5-year view on this company. I have like a 2-year.
2 year. Okay, that's fair.
5 years from now, because if they go into, so I think if it's me, they have a credit building credit card. They're somewhat working on the neobank, and they're the largest EWA platform, or maybe the most profitable at very least. The thing I don't know is because Chime went public. Chime has an EWA product. It's not as good as Dave's, or not as profitable as theirs. And there's other players, and we'll see where that space goes. But right now, I think my guess is they'll remain the place as the largest and most profitable player in the space, and will continue to take market share in these payday loans. I will say this: if they figure out a way, and we just know from talking to people, their what's the word? Their loss ratio is half what anyone else can do. Everyone else is like double their losses, which is an insane stat. If they can find a way to do that in the payday lending space, where they're doing slightly larger loans, and they're able to do something like it costs you $200 to access $1,500, so half, or 40% of what Opturn does, and they do that and are able to be profitable on it, that's an insane market for them. So if they can break into that, that's an insane future TAM that they can access. That if they break into that, this company could be, I'm not going to say like massive, like this isn't the next $100 billion company, but they could easily get to be 10 billion if they can break into that.
And just to lead you on here, or lead you into something, the management team, they've shown the capability for opportunistic buybacks already, right?
Mm-hmm.
Wasn't there one just before this run up?
Yeah, they did a $50 million buyback plan, and I think they exercised a lot of it in the Q1 when the company was depressed, because they're looking at themselves and going, yeah, and that's the other thing with this. It's just printing cash now. So management has an option to either reinvest in the business, or, return capital to shareholders, or maybe do a little bit of both. I wouldn't be surprised to see the buyback program expanded. And at current multiples, buying back stock is a really good option for them.
Yeah. I mean, for the enterprise that they are, I mean, you see like they have an employee count and under 300 people. There's under 300 people at this thing. It's literally just printing money. It's pretty, I don't know why it's not sexy, why it's not more popular.
Look at that return on equity, return on assets.
Yeah.
Return on capital.
Going in the right direction.
I mean, would you want to buy that ROIC chart right here?
No. I'd rather buy some other obscure fintech that has much worse metrics by comparison, but is talked about by all the retail. I like to be greedy when others are greedy, kind of thing.
I like to be greedy when others are free fall. I started buying real estate in Iran.
We haven't done content on Iran yet, so.
I saw a tweet about that today. Anyways,
all right,
but that's about it on Dave. I don't have anything else. It's my largest holding by a lot, partially because it grew into it, partially because I have been buying. I added this company at 190 recently when it pulled back to that. In fact, I tweeted about it. I put out a little spicy tweet in case anyone didn't see it. Don't know if it's appropriate for our stream here, but
no. This is, you can show it.
No, yeah, but no, I mean, like, so I still think it's incredibly undervalued today. I don't know, like, I do know ways that it won't work, but I find them very unlikely. So where was I? This was me a couple days ago.
Yeah, I did see that. And then follow it up.
Yeah, I succumbed to temptation. so that's where we're at. And like I said, it's a stock where if you look at it, people are like, man, this thing, it looks like a quantum computing, what are the other companies that you're thinking of? Space, just any of those meme stocks that people are like, there's no fundamentals backing it up. It's not trading at that. If you compare it to those quantum computing companies trading at 5,000 times sales, this is trading at 17 times earnings. It's a very different situation. It's a very real company that's making very real profits, and I think will continue to do so. That's
Agreed.
That's where I'll end it.
All right. With that being said, thank you guys so much for joining us in today's episode. And if you guys are interested in joining the Capital Mindset Club, you can check the description down below, as well as leave a like, share, and subscribe. With that, we'll be seeing you guys on the next episode. Bye.